So, if you filled up your car lately, you've probably noticed something, well, something surprising. After years of painfully high prices, that number on the pump is actually going down, and it's staying down. But the reason why is a really fascinating story. We're talking global politics, high-stakes deals, and a huge bet on the future of energy.
Okay, let's just jump right into the big question here, because this is a massive reversal. For years, OPEC+, that super powerful group of oil countries led by Saudi Arabia and Russia, was doing everything it could to cut supply and keep prices high. So what on earth changed in 2025? Why the sudden complete U-turn?
And look, this wasn't some tiny tweak. Since April of 2025, key OPEC+ members have cranked up production by a staggering 2.9 million barrels every single day. To put that in perspective, that's more oil than some entire countries produce. This was a huge, deliberate move designed to flood the market and, you guessed it, bring prices way down. To solve this mystery, we actually have to start not in the oil fields, but in the White House. The first, and maybe the most critical piece of this whole puzzle, is what a lot of analysts are calling the Trump factor.
Almost as soon as he was back in office, President Trump made a direct appeal to Saudi Arabia, the single most influential oil exporter in the world. The message was really simple: open the taps. The goal, make oil cheaper for everybody, but especially for consumers back home in the US.
And this isn't just some theory we're floating. Experts are pointing directly to this link. As Francis Perrin over at the Institute for International and Strategic Relations puts it, this political pressure isn't just a part of the story. He says it's absolutely essential to understanding the whole thing. So, you're probably asking, why did Saudi Arabia just go along with it? Well, it was a classic quid pro quo. You scratch my back, I'll scratch yours kind of deal. In exchange for pumping more oil, the United States offered Riyadh two things it really wanted: access to cutting-edge American AI systems and, crucially, the green light on a deal for civil nuclear energy. This was way bigger than just oil. It was a major diplomatic and tech exchange.
So a political deal unleashes this flood of oil onto the world stage. The next big question is, where's it all going? Let's take a look at how the global market is actually handling this sudden surplus.
The impact on prices was, well, dramatic and fast. Just look at this data from the U.S. Energy Information Administration, the EIA. This shows the forecast for Brent crude, which is the big global benchmark. It dropped from $81 a barrel in 2024 down to a projected $69 for 2025, and it's expected to fall even more. The trend here is just crystal clear.
So who's buying all this cheaper oil? Well, what's interesting is the growth isn't really coming from established economies, the OECD countries like the US and in Europe. In fact, you can see their demand is actually shrinking a little bit. The real growth, all 1.1 million barrels per day of it, is coming from developing nations, especially over in Asia.
But there's another major player helping to soak up all this extra supply: China. The EIA points out that China has been buying up huge amounts of this cheaper oil to fill up its strategic stockpiles. And this stockpiling, has basically created a massive new source of demand that's helped prevent prices from totally crashing. It's been a key stabilizing force.
Okay, so that's the big global picture, but let's bring it all back home. How does a deal for AI systems in Saudi Arabia and a stockpiling spree in China actually change the price you're paying at your local gas station?
To get this, we got to break down what you're actually paying for. See, the cost of the crude oil itself is the single biggest chunk of the price of gasoline. So when crude prices fall, that piece of the pie gets smaller. But, and this is important, notice it's not the only thing in the pie.
A key part of that refinery slice of the price is something the industry calls the crack spread. Now, it sounds super technical, I know, but it's really just a fancy term for the profit margin that a refinery makes when it turns crude oil into gasoline.
And here's the catch. Even as the cost of crude oil has been falling, those crack spreads have been rising. This means the refiners are taking a slightly bigger piece of the pie for themselves. It's the reason why a 20% drop in crude oil doesn't automatically mean a 20% drop for you at the pump. It kind of acts as a cushion, softening the fall.
So with all that factored in, we've got cheaper crude but higher refiner margins. What's the final number? What's the bottom line? Well, the EIA is forecasting that the average retail gas price in the US will fall to just under $3 a gallon in 2026, specifically $2.98. So that's the story of 2025, a year of big surprises and totally new dynamics in the oil market. But what does the near future hold? Let's take a quick look at the forecast for 2026.
The official outlook is pretty clear. This downward trend is set to continue. The EIA projects Brent crude will keep on falling, hitting an average of just $55 a barrel in 2026. I mean, think about that. That's a huge drop from the $81 we were seeing back in 2024.
Which really leaves us with one final critical question. The lower prices of 2025 were engineered. They happened because of a political deal. But the fundamental forces of the market, like that soaring demand from developing nations, they haven't gone anywhere. So the real question is, should we get comfortable with cheaper gas, or is this just the calm before the next storm?